Right now, someone is holding a piece of paper that says they own an ounce of silver. In fact, for every single ounce of physical silver sitting in a vault, there are potentially hundreds of people holding a digital claim. It's the ultimate musical chairs, a game of the financial world. And the music isn't just slowing down, the power is about to be cut. Welcome back to Shadow Finance. Today, we're looking at the math that Comex and the big bullion banks hope you never do. We're talking about the paper default. It's the moment when the world realizes there isn't enough metal to go around. Your digital portfolio becomes nothing more than a receipt for a bankruptcy court. If you think your Silver ETF is safe, think again. In the futures market, silver is traded in contracts. One contract represents 5,000 ounces. But 99% of these traders never take delivery. Because the system assumes no one wants the metal, the banks sell more contracts than physical silver exists. This is paper silver. When a massive wave of paper selling hits, it creates an artificial supply, driving the price down even when shops are sold out. Registered silver, the stuff available for delivery, is at multi-year lows. We are seeing a drain that hasn't happened in decades. Think about the scale. Total global production is roughly 800 million ounces a year. Yet, that entire amount can be traded in hours. It's possible because the majority of that silver doesn't exist. It is a digital ghost, a credit-based system built on a dangerous assumption. The Fed can print more dollars to bail out a bank, but no one can print more silver to bail out the Comex. Registered silver is the only silver available to back contracts. Over the last 2 years, we have watched this category bleed out. As registered approaches zero, the leverage becomes infinite. The paper price becomes irrelevant because it no longer represents anything real. For decades, institutions have used massive capital to short the market, dumping paper contracts at 2:00 a.m. when liquidity is low. The smart money is no longer satisfied with digital entries. They want the bars because of geopolitical instability and currency debasement. In Shanghai, silver is trading at a significant premium. This creates a vacuum, draining the West's reserves to feed demand in China and India. When the vaults hit Comex zero, banks will pull their last lever, force majeure. Hidden in the fine print is a cash settlement clause. In a paper default, you get your dollars back, but those dollars can no longer buy the silver you thought you owned. Unlike gold, silver is an industrial workhorse essential for solar panels, electric vehicles, and 5G infrastructure. When a solar manufacturer needs 100,000 ounces, they don't care about the paper price. They will pay whatever is necessary to get the metal. The psychological trap of the paper market is its convenience. It's easy to click a button, but physical silver has no counterparty risk. We're moving toward a two-tiered market, a fantasy paper price for the masses and a real physical price for those who hold metal. Watch the delivery numbers. Every ounce that leaves the vault is an ounce that can no longer be used to back 100 paper contracts. The paper default isn't a matter of if, but when. The math is unavoidable. You cannot have infinite claims on a finite resource. Protect your wealth while you still can. Thank you for watching Shadow Finance. Stay ahead of the curve.